This little piece I'm going to call Taxes, You and Me. We're going to look at how taxes affect us as people a little bit. To get there, we have to look at a couple of mechanical things that aren't as mechanical as they sound if you just set aside the sensation of math and focus on what these things mean. They're not too bad. The first of these is the average tax rate. Now, the average tax rate can be expressed in mathematical terms if we want to sound smart and intimidate people. Let me just do that and then step away from that, okay? The average tax rate is the total taxes paid divided by the person's income. Total taxes paid divided by income. Now, stepping away from math, all it means is what portion of a person's income is he or she spending on taxes. That's the average tax rate. It's simple. Don't overcomplicate it. What portion of the person's income are they spending on taxes? And so you might say, well, I get that from my pay stub, which is true. That's the portion of your income that you're spending on your income taxes. But it's not necessarily the portion of your income you're spending on taxes. This is how politicians can say different things and both of them be technically not lying. Because there is the portion, your average tax rate of your income taxes. That's right there on your pay stub. You spent this much on taxes. You divide that by your income. That's your average income tax rate. But what if you go with the money that you didn't spend on taxes over to the convenience store and you sit in one of those plastic chairs at the convenience store and play Keno all day long on a Saturday? On average, you're not going to break even. That's how they make money on lottery. I'm picking on lottery because lottery is a state-run program which raises money from the residents in the state. It's a state program that raises money from the residents in the state. That's called a voluntary tax. So going back to our average tax rate, you have, according to your pay stub, how much you pay in income taxes. You could divide that by your income and see what your average tax rate is, sure. But that's not all the taxes you pay. Then after you go to Keno and you pay some voluntary taxes, you should add that in to what you spent on your income tax and then divide that by your income, and you'd see you spent a greater average tax rate than you initially thought if you only looked at your income taxes paid. But then if you think about all the stuff that you bought for which the sales tax applied, 6% was taken out of your total income in the form of you spending it on that stuff for which the sales tax rate is applied. And then you should add that in there on the top of that little expression to get how much you paid in taxes. Now, if you've bought cigarettes or alcohol, these have excise taxes applied. They're masked within the price. There's the 6%, but there's also excise taxes levied on those sellers that you are sharing as a consumer, so you're paying part taxes on those as well. So actually, your average tax rate, if you thought about all the money you're spending in taxes, is probably much greater than you realized if you only looked at your income tax divided by your income. It's starting to get interesting, I know. Hence the darkness all around me. Just wait. So that's your average tax rate. That's what it means and how you can apply it to find something interesting. Before I can get to the next sort of way to look at that, I have to delve into another kind of mathematical kind of term, but really it's not so much. That's the marginal tax rate. The marginal tax rate is your change in your tax payment divided by your change in income. That's mathematical. Don't worry about it. That's just what it is in math terms. What it really means is how much of your next dollar, if you get a raise, how much of your next dollar are you going to be paying in taxes? In other words, we're referring here to this idea of tax brackets. You see, in the state of Maryland and in the federal government, we have tax brackets. As you make more money, you move up into a higher tax bracket, and you get charged a higher marginal tax rate on that new money above what you used to make. Now, one thing about the mechanics of calculating this, If you're in the lowest tax bracket, you pay this rate for your income. And then you get a raise, and you're in the next tax bracket. You don't pay that rate on all of your income. You only pay that rate on the income over the threshold of the bracket. So if your tax rate were 5% before, let's say you made $10,000 and you paid 5%, that would be $500. So that's your tax obligation on your first $10,000. Then you get another $1,000 raise, and you move into, for simple numbers, a 10% bracket. Well, now you owe your $500 on the first $10,000. So that's your tax obligation there. But then on the new $1,000, you owe another $100 on that, because that's 10% on the $1,000. So now your total tax bill is $600. So that's how the marginal tax rate works when it's applied. But the bottom line is, as you make more money, you pay a greater tax rate on the more additional money that you're making. If that's how things pan out at the end of the day, that's called a progressive tax system. Progressive tax system is what we have on income taxes in the state of Maryland and for the federal government. As you make more money, you pay a higher percentage of that money to taxes. That's the idea of a progressive tax system. There's some things that get in the way of that, though. One is what is called loopholes. If people are making a high income and they have accountants that can help them avoid paying taxes, the stated progressive tax system might not come to be the real progressive tax system. That's just the nature of accounting and the rules that we have set up. For example, tax deductions. If you make donations to charities, that's tax deductible. That's to encourage making donations to charity. That also reduces that marginal tax rate. So the stated progressive tax system might not come out to be that progressive for a person if they're making those donations. So we make rules, and we do that for reasons, but sometimes those reasons counter other things. Recall, what we're looking at is this balance between social justice, economic efficiency, and individual liberty. Right? In that example, if you want to support a charity, that's your individual liberty. We want to have social justice in the sense of having a progressive tax system, but they're conflicting, right? So that's the idea of the marginal tax rate. That's what it means. That's also the idea of a progressive tax structure. Now, it might be that if we went thinking back to that average tax rate, if we examine people's behavior, let's say across people, and you have a person who's low income, they're in a low tax bracket. So their average tax rate is low. Owing constant any kind of a raise, just their current, what they're paying in taxes and income could be low. Now let's say the weekend comes, and that person goes over to a convenience store and sits down at one of those plastic tables in the plastic chairs in front of the Keno machine and plays lottery all day long. Keno. Keno is hosted by the Maryland Lottery, which is a government agency that raises money for the state from the residents of the state. Raises money for the state from the residents of the state. Is that not a tax? It's called a voluntary tax. So here's this person who's in a low tax bracket and thus has a low average tax rate, but then spends the money they get after taxes, a large portion of it anyway, on a voluntary tax. If you add what they spent in the voluntary tax to what they spent in their income taxes, you would have a very different average tax rate than you did only looking at the income tax. Now let's compare that to another person who maybe makes more money. If they make more money, they're in a higher tax bracket. Their average tax rate would be higher than the person who doesn't make as much. But if this person doesn't participate in voluntary taxes, it could be that the person with lower income pays more of their income in taxes than the person with higher income. If that is the outcome of our tax system, then we have what's called a regressive tax system. That's where, as you make more money, your tax rate goes down. So net of the different kinds of taxes that are out there, and a really fun thing to think about is beyond just what we see on our pay stubs, which is a progressive system, to all of the taxes we have and apply them to individuals to see what kind of a tax system we really have. We might find it's not as progressive as we think it is because of voluntary taxes and possibly because of excise taxes. Remember, those are the sin taxes, alcohol and cigarettes. If that same person is someone who plays Keno on Saturday and drinks on Sunday, compared to someone who doesn't do those things, it's very likely that this person is paying more of their income in taxes than the person who doesn't do those things but makes more money. Which, again, we're trying to balance the social problem of mankind is balancing those three things. And if we're trying to balance them, then one takeaway from this is, well, what really goes into what we're doing here? Is it just the income taxes, or is it these other things that we do that maybe are affecting this balance? I think it is. I think it's fun to think about anyway. So that's the progressive tax system. That's the regressive tax system. If the tax rate is constant as income rises, that's called a proportionate tax system, also called the flat tax. And these things, of course, could be true in just the income taxes. I like to think of them across all the different taxes because I think that's the more true application. And I also think it's more interesting in what we're trying to do to and for people. Now, why these things are important to us is because we are interested in balancing those three things, even if we've never thought about it before. And so in balancing these, we might, as we're looking at how to tax something, we might use two different guiding principles that sometimes go together and sometimes they conflict with one another. One of these is called the benefits principle. The idea of the benefits principle is whoever gets the benefit from the government service pays the tax that provides the service. Whoever gets the benefit from the service pays the tax that provides the service. So an easy example of the benefits principle is the Route 50 bridge over the Chesapeake Bay. I drive on it all the time. I have an Easy Pass. I get zinged whenever I drive on the bridge on my Easy Pass. That's a tax. I'm choosing to use that service. I'm paying the tax that pays for that service. I'm paying for the Bay Bridge with my tolls. That's the benefits principle in action. There are people in the state of Maryland who don't drive. They are in no risk of using that bridge. A fair argument is, why should they have to pay for it? Because the alternative to tolling would be to have the general fund of the state of Maryland pay for all the bridges, but that would mean taxpayers across the state, whether they used it or not, would be paying for that bridge. This gets us to the other principle. It's called the ability to pay principle. Well, on our income taxes, we do have a progressive tax system on income taxes alone. As you make more money, your income taxes go up. Well, if you're a person who doesn't drive or doesn't drive on that bridge, you would be paying more for that bridge than someone who makes less money but does use it. The argument for such things would be this: you have a greater ability to pay. And for some things, that makes more sense than other things. I think the bridge, most people would say that really probably doesn't make sense. It doesn't make sense for you to pay for a bridge that you're never going to use just because you have a greater ability to pay for it. People who do use it, probably makes more sense for them to use it. So that's the ability to pay principle versus the benefits principle. I think an interesting thing to consider is property taxes. I think these things overlap on property taxes because, you see, property taxes fund our public schools across this country on the municipal level, on the county level. So each of our counties in Maryland, there are 23 counties in the city, have their own property tax rates. And some areas in each of these counties are very affluent. The property values are very high. And so the property taxes in dollars are high on high dollar properties. But here's a fun thing to consider. That property tax that's being collected goes to the schools. That's how we fund our education mostly. Well, guess what the relationship is between the quality of schools and property values? It's a positive relationship. Good schools tend to lead to high property values. Of course, high property values tend to lead to good schools. So if you're an affluent person, even if you don't have any kids and you're not going to utilize the service of public education, you're paying more because of your ability to pay. But you're also deriving a benefit because having good schools protects the value of your property. So sometimes the ability to pay principal is in conflict with the benefits principle. And sometimes they sort of ride together. But as you're assessing the way things are best for our society, it's certainly good to be aware of these general concepts and to have a feel for these, maybe even more than a feel, maybe some ability to put a paper and pencil together and analyze these things. So I think that's about all I can say about these principles and these big picture items around taxes. I think our next step is to get to the model of taxes in a market and explain all this darkness.